Nvidia has entered what I call the golden treadmill. It is a high-stakes environment where the company is forced to accelerate its product cycle to a relentless one-year cadence just to maintain its dominance. But here is the catch. This breakneck speed is secretly eating away at its legendary margins. Is this the peak of a monopoly, or is the world's most powerful engine finally starting to overheat? When we perform a deep stock market analysis, we have to look past the flashing green numbers on the screen and peer into the machinery of the business itself. To understand the future of your portfolio, you have to understand the difference between a company that is growing and a company that is evolving into something entirely different. Despite a staggering 65% surge in annual revenue to $215.9 billion, Nvidia's gold standard gross margins actually compressed from 75% to 71.1%. Now, if you are new to this, think of gross margin as the purity of a company's profit. It is the money left over after the direct costs of making a product are paid. Like the profit a lemonade stand makes after buying the lemons and sugar. A 75% margin is elite. A dip to 71% might seem trivial, a mere rounding error in the face of triple-digit growth. But when we look under the hood, the picture changes significantly. This contraction suggests that the sheer complexity of scaling full-scale Blackwell data center solutions is significantly more expensive than just selling standalone chips. As the company transitions from being a component vendor to a full-scale systems provider, it faces a classic paradox. It is growing larger while becoming fundamentally less efficient for every dollar earned. The golden rule for us as investors is to understand that revenue quality matters more than revenue quantity. This is exactly why your portfolio might feel volatile despite record-breaking headlines. The market is starting to price in the massive costs of this complexity. This is something you can easily check for yourself by looking at the cost of goods sold relative to revenue growth. Once you grasp this, you will start to look at financial reports in a completely new light. It means that scaling a mountain is easy when you're carrying a light pack, but as Nvidia starts carrying the entire weight of the world's data center infrastructure, every step becomes more expensive and every breath becomes more labored. To understand why these margins are tightening, we have to look at the $4.5 billion ghost currently haunting their warehouses. Management recently took a massive one-time charge for excess inventory. In the world of fundamental analysis, an inventory write-down is essentially a company admitting that the goods in its warehouse are no longer worth what they thought. Think of it like a grocery store realizing its milk has gone sour before it could be sold. This was a rare miscalculation in demand forecasting caused by shifting regional policy hurdles. The consensus view is that this was a one-off event, a simple adjustment to a changing world. But the twist is far more concerning for long-term holders. This write-down on specific international products proves that even a market leader is vulnerable to the sudden volatility of global regulatory shifts and regional tensions. It serves as a stark warning that in a hyper-growth environment, today's cutting-edge technology can become an expensive, unsellable liability overnight if market access is suddenly restricted. This is exactly why relying on a single growth story is dangerous. When the rules of the game change mid-match, even the best player on the field can find themselves holding billions of dollars in obsolete equipment. This inventory risk is the hidden tax on hyper-innovation. It suggests that the golden treadmill requires Nvidia to run perfectly just to stay in the same place. An effective investing strategy must account for these invisible regulatory walls that can appear without any warning. But to fully grasp why the pressure is mounting, we need to look at the strategic shift to a one-year product roadmap, moving from the current Blackwell architecture to the upcoming Rubin architecture. The setup seems simple. Why wait 2 years for a revolution when you can provide one every 12 months? On the surface, this maintains a technological lead that no competitor can touch. But the twist is what I call the one-year trap. By setting a pace that few customers can actually afford to keep up with, Nvidia increases the risk of catastrophic execution errors. If the transition to Rubin in the second half of fiscal year 2027 faces even a minor delay, the company's promise of a predictable cadence could turn into a narrative of overextension and operational fragility. This forces customers into a cycle of constant hardware replacement, which creates an exhausting capital expenditure burden. For you as an investor, the lesson is clear. Speed is a competitive advantage until it becomes a structural risk. If the engine is tuned to run at the red line constantly, the smallest piece of grit in the gears can cause the entire system to seize. This is a simple rule, but it is incredibly powerful for evaluating high-growth tech stocks. When you look at the price-to-earnings ratio or the price-to-sales ratio, you must ask if those multiples are sustainable if the product cycle ever slips by even a single month. And this brings us to the real elephant in the room: perilous concentration. Currently, just 2 direct customers account for 36% of Nvidia's total revenue. Think of it this way: if Nvidia were a landlord, more than a third of its rent would come from just 2 tenants. At first glance, having the world's largest cloud giants as your primary backers seems like the ultimate safety net. However, this creates a fragile dependency on a handful of elite entities. This extreme concentration means that any cooling in capital expenditures from just 2 corporate boards would have a massive impact on Nvidia's top line. The company is essentially hitched to the investment whims of a tiny elite, making its record-breaking growth vulnerable to a single corporate pivot or a shift in focus toward internal silicon development. This is why diversification is not just a strategy for your portfolio, it is a survival requirement for a corporation. This is a core pillar of value investing, looking for a margin of safety not just in the price, but in the customer base. When your destiny is controlled by the spending habits of 2 neighbors, you are not a sovereign power. You are a tenant. Ask yourself, if these 2 giants decide to build their own chips next year, where does that leave the current valuation? To fight this dependency, Nvidia is executing a brilliant networking pivot as a defensive moat. Data center networking revenue recently exploded by 142%, signaling that the company is successfully rebranding itself as the architect of the entire artificial intelligence fabric. Most people focus on the graphics processing unit, which is essentially the brain of the system. But the twist is that the brain is useless without the nervous system. By controlling the interconnect through InfiniBand and Ethernet, Nvidia makes its ecosystem nearly impossible to leave. Whether a customer uses a specialized processor or a general one, they still need Nvidia's networking to make the system talk to itself. This strategic shift moves the goalposts from selling hardware components to owning the entire digital infrastructure of the modern age. The lesson here is that the most valuable part of a house isn't the bricks, it's the foundation and the plumbing. By becoming the plumbing of the AI world, Nvidia creates a stickiness that transcends the individual chip. This is the kind of insight that separates a basic stock market analysis from a professional deep dive. But as corporate demand faces potential saturation, management is pivoting toward what they call sovereign AI. This involves enabling nations to build localized computing power. The mainstream interpretation is that this is just another sales vertical. But the reality is a high-stakes bet on the nationalization of artificial intelligence as a critical resource. This strategy taps into national interests and data residency requirements, providing a massive new revenue stream that is less sensitive to traditional business cycles. For an investor, this represents a hedge against corporate belt tightening. If a private company stops buying chips, a nation-state building its digital future likely won't. This move towards sovereign infrastructure is a masterclass in market expansion, turning a technological product into a matter of national security and identity. It is a bold investing strategy that seeks to decouple the company from the volatility of the private sector. It transforms the business from a discretionary tech spend into a mandatory national utility. However, even a master of expansion must play defense. The $17 billion licensing agreement with Grok, which generated a staggering $14.4 billion in goodwill, reveals Nvidia's willingness to spend aggressively to neutralize potential architectural threats. In fundamental analysis, goodwill is the premium a company pays over the fair value of an asset. It is the brand value or strategic value they are buying. At first glance, this looks like a standard partnership, but the twist reveals a defensive posture intended to lock down their technological moat at any cost. By absorbing specialized technology and licensing it back, they are essentially buying insurance against future disruptions in the AI inference market. This highlights their fear of a black swan technology emerging from a startup that could render their current architecture obsolete. The lesson for us is that maintaining a monopoly is an expensive endeavor. Sometimes you have to pay a massive premium just to ensure that a competitor does not get a foothold in your backyard. Even in the world of value investing, we must recognize that a high price today might prevent a total loss tomorrow. This aggressive spending is fueled by a cash fortress that would make a central bank jealous. With $62.6 billion in liquidity and $40.4 billion recently spent on share repurchases, the company is operating with unprecedented financial might. While this buyback program supports the stock price and manages dilution, it also raises a critical question. Has Nvidia run out of needle-moving acquisition targets? The narrative tension lies in whether this cash should be returned to shareholders or deployed to solve the supply chain's single point of failure risks. Currently, Nvidia is entirely dependent on a single wafer fabricator and a few high-bandwidth memory suppliers. If that narrow bridge collapses due to regional shifts or global uncertainty, all the cash in the world will not build a new factory overnight. This is the ultimate paradox of the modern tech giant. They have more money than almost any other entity on Earth, but they are still beholden to the physical limitations of a few specialized factories. This is a critical point to consider in any long-term investing strategy. Finally, we must acknowledge the regulatory ceiling. Despite record-breaking results, Nvidia is effectively restricted from major international markets that once represented a significant growth engine. New licensing structures and policy shifts add layers of friction that favor local competitors in those restricted zones. This regulatory wall represents an invisible ceiling that forces the company to extract more and more value from a shrinking geographic footprint. It is a reminder that no matter how fast you run on the treadmill, the room you are in has walls. Nvidia is no longer just a chip company, it is a system architect running a race against its own obsolescence. The transition to a one-year product cycle will lead to a permanent increase in inventory write-downs as the useful life of AI hardware continues to shrink. However, the explosive growth in networking revenue will likely outpace compute growth over the next 24 months, becoming the primary driver of ecosystem stickiness. While the risks of customer concentration and regulatory ceilings are real, the move towards sovereign AI provides a buffer that most analysts are underestimating. That is why I believe that within the next 24 months, the market will stop valuing Nvidia as a hardware manufacturer and begin valuing it as a global utility. This is a shift that will redefine the very concept of a moat in the digital age. But I want to hear your take. Do you believe Nvidia can successfully transition from a chip maker to a global utility, or is the one-year trap of constant hardware cycles destined to catch up with them? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.